Insight, let's go to the Bloomberg News Bureau in downtown Toronto, where we're joined by Decloet, managing editor for Canada at Bloomberg News. And we're also joined by Greg Newman, senior wealth advisor at Scotia Wealth Management, our featured guest of the morning. Derek, thanks a lot for joining us. What will you be watching for in the fall fiscal update this afternoon? Derek's in Ottawa.
A couple of things. One is, yes, I'm in Ottawa. Thank you for having me on. One thing, of course, is housing. As you said, there is going to be money in this statement to try to stimulate home construction. It's obviously the number one issue, really, that the government is focused on right now. We'll also be looking pretty closely at the fiscal track, not only in this fiscal year, which only has a few months left, but in the next couple of years. So when Freeland tabled their budget in March, was projecting a $40 billion deficit for this year, $35 billion for next year, $27 billion for the year after that. But we know that economic growth is moderating and rates are higher, and interest costs on the government debt are up significantly already so far this year. So they really are constrained in a way by interest rates. That the Trudeau government really has never been constrained in this same way before, because they've almost all of their 8 years in power, they've been in more or less a low-rate environment until about the past year.
Your colleague Eric Herzberg, who will be part of the team at Bloomberg covering the update today, has made the point in a recent piece that interest charges on the federal debt are up 35% in the first 8 months of this year versus the same period in 2022. How much pressure does that put on the government to dial back spending?
Yeah, that equals about $8 billion Canadian. And $8 billion is not what it used to be, but it's still significant. The government also has to be mindful of trying to protect the credit rating, trying to protect the position. Politically speaking, Prime Minister Trudeau and Freeland have always been able to kind of try to deflect the criticism about their spending with those facts, right? We still have a AAA credit rating. We have the lowest deficit to GDP ratio in the G7, and so on. So they very much want to protect that as sort of the guardrail. But there's definite concern in the business community about the overall trajectory of the budget, about that rise in interest costs, and really about where those interest costs go in an environment where, let's say, you get a 10-year rate at 4% over the long run, or 3.5% over the long run. That can have a really significant impact on how much of our budget over the long period of time goes toward paying interest on the debt. So they really are, I think, constrained.
Greg Newman of Scotia Wealth Management, your take on what Bay Street will want to see today?
Listen, I think that, inflation coming in within the parameters, I think we're looking for 3.1% up, and that or anything more benign will be very welcome by Bay Street. I mean, this conundrum of stubbornly higher for longer interest rates is what is maybe concerning everybody, that we could be going into a harder landing and not a soft landing. So inflation under control. It's been coming in within expectations in the States, and that's been important, and we definitely want to see the same thing.
Is Tiff Macklem correct in urging governments, in pretty blunt language, for a central banker to control their spending and to start, in his phrase, rowing in the same direction as the central bank in terms of trying to bring inflation down? This is
probably the brightest mind in Canada on the subject, so I think I'm going to go with him on that. But as our guest just said, we do have some room. I mean, we are, of the G7, still of the highest credit rating. So it's a tough balancing act for the government to achieve here in trying to boost spending for housing and also keep inflation under control.
Derek, how much pressure do the Liberals feel to satisfy the NDP, who, of course, want greater spending on a variety of things, including housing and including a national pharmacare program?
That's right, and the pharmacare thing is in the supply and confidence deal that the NDP and the Liberals struck last year, that they're supposed to have pharmacare legislation on the books by the end of this year. doesn't really look like that's going to happen. And pharmacare, to be clear, at least as the NDP envisions it, is a very expensive program. That would be a significant hit to the budget, and something I think that the credit agencies would take a hard look at. A lot of the measures you're going to see today are either long-term in nature, things like investment tax credits, more detail on those, or relatively small in terms of the fiscal impact. Pharmacare is different, and I think you're not hearing the government talk about it in part because it's probably not realistic right now.